Have you ever stared at a chart, found the perfect setup, entered the trade with full confidence, and then watched the market smack you in the face? Yeah, I've been there too. In fact, every trader has. On paper, technical analysis looks like a magic key to profits. Patterns, indicators, signals, it all seems so logical. But once you put real money on the line, the market suddenly stops playing by the rules. Here's the truth. Technical analysis doesn't fail because it's useless. It fails because most traders don't understand what it really is, how to use it, and most importantly, where it breaks down. This video is about those breakdowns. Why the patterns don't always work. Why emotions hijack your trades. Why the market laughs at your indicators. And how you can rise above it all by focusing on the things that actually give traders an edge. If you've ever felt betrayed by your charts, this video will finally make sense of it all, and maybe even change the way you trade forever.
Chapter 1. The Illusion of Patterns. Have you ever looked at a price chart and thought, this is it, I see the setup, the market is about to move exactly the way I predicted. The candles line up perfectly, the formation looks identical to the examples you saw in trading books, and for a moment you feel like you've cracked the code. But then, almost instantly, the market flips in the opposite direction, and what looked like the perfect setup suddenly becomes a painful loss. This isn't just bad luck. It's the beginning of understanding one of the biggest reasons why technical analysis often fails: our brain's obsession with finding patterns. Humans are hardwired to make sense of chaos. Thousands of years ago, this ability kept us alive. Spotting a pattern in animal tracks helped us avoid predators. Recognizing the change of seasons allowed us to grow food. The problem is, that same wiring follows us into trading. When we stare at charts, our brain desperately tries to make meaning out of random movements. We see shapes, triangles, flags, head and shoulders, not because they're always there, but because our brain wants them to be there. Psychologists call this apophenia, the tendency to perceive connections and patterns in random data. In trading, it's both a gift and a curse. A gift because being able to spot genuine recurring behaviors in the market can create opportunity. A curse because much of what we see is simply noise dressed up as signal. Let me give you a relatable example. Imagine you flip a coin 10 times. The odds say it should land heads about 5 times and tails about 5 times. But what if you get heads 6 times in a row? Most people immediately assume a streak is happening, as if the coin somehow knows it should keep landing on heads. In reality, it's still just 50-50 on the next flip. The streak doesn't mean anything, but our brains are tricked into believing there's a pattern. The exact same thing happens in trading. When prices move in one direction a few times, we assume momentum is building. When they zigzag in a certain way, we assume a breakout is coming. The truth? Many of these signals are just as meaningless as the coin toss streak. Traders love to talk about patterns like head and shoulders, double tops, or cup and handle formations. These are taught as if they were laws of nature. You'll see books showing how reliable they are, complete with perfect textbook examples. But the moment you step into live markets, those textbook patterns rarely behave as advertised. A head and shoulders may form, but instead of breaking down as expected, price shoots up. A double bottom may form, but instead of launching into a rally, price stays flat or crashes further. Why does this happen? Because the market is not a textbook. Real trading is driven by countless variables that can't be captured by a simple shape. Economic news, institutional orders, central bank decisions, earnings reports, and even global politics, all of these can override any technical pattern in a second. I still remember my early years as a trader when I saw my first perfect head and shoulder setup on a stock chart. I was convinced I was about to make money. The neckline broke just like the book said it would, and I confidently entered a short trade. Within minutes, the price reversed violently, trapping me. What I thought was confirmation was actually just noise before a massive rally. I lost money, but more than that, I lost confidence in what I thought I knew. That experience taught me a painful but priceless truth. Patterns don't guarantee outcomes, they only hint at probabilities. This is where many traders get trapped. They confuse probability with certainty. A pattern might sometimes work, but not every time. And when it doesn't, the losses can be devastating, especially if you built your entire trading plan around the belief that patterns are destiny. Here's another psychological trap: selective memory. Traders tend to remember the times patterns worked beautifully and conveniently forget the times they failed. This creates the illusion that patterns are more reliable than they actually are. You might recall that one perfect breakout trade that made you money, but you'll forget the 6 failed breakouts that drained your account before that. This memory bias reinforces the belief in technical setups, making it harder to question them. The danger isn't just in seeing patterns, it's in the overconfidence that follows. When you believe a chart is giving you a sure thing, you increase your risk. You put more money into the trade. You ignore stop losses. You double down when the trade goes against you, thinking the pattern must eventually play out. But markets don't reward overconfidence. They punish it. Now let's talk about another critical piece: liquidity. In theory, patterns reflect supply and demand, buyers and sellers pushing price in recognizable ways. But in live markets, big players control liquidity. Hedge funds, banks, and high-frequency traders have orders so large that they can move prices in ways that make retail traders' patterns meaningless. Imagine drawing a neat triangle on your chart, expecting a breakout, while a large institution places a billion-dollar order that completely erases your setup. Your pattern didn't fail because the chart lied. It failed because someone with far more capital erased it from existence. One of the most humbling lessons in trading is realizing that the market doesn't care about your chart drawings. The market doesn't care about your lines, your indicators, or your favorite pattern. The market moves because real money flows in and out, and those flows are often invisible to the average retail trader. Let's revisit the concept of backtesting for a moment. Many traders will say, "But patterns work. I backtested them." Yes, backtests can show historical success, but here's the catch. Backtesting is like fitting a suit to one person. It looks perfect on that person, but that doesn't mean it will fit everyone else. Market conditions change. What worked in the past may not work in the present. When you backtest, you're fitting your rules to historical data. The market of today, influenced by new technology, new players, and new events, may not behave the same way. And this brings us to the hidden danger: overconfidence in fragile signals. A trader who believes too much in patterns is like a driver who trusts a GPS blindly, even when the road signs say dead end. Patterns are helpful as guides, but they are not absolute truths. When traders treat them as gospel, they set themselves up for disaster. So, how do we break free from this illusion of patterns? It starts with awareness. Recognize that your brain is designed to seek meaning in randomness. Understand that patterns are not guarantees, but probabilities. Learn to question what you see on the chart and always ask, is this signal strong enough to risk my money on, or am I just seeing what I want to see? A professional trader doesn't rely on one pattern or one setup. They build a framework that considers multiple factors: market context, risk management, fundamental drivers, and yes, sometimes technical signals. But the difference is they never mistake those signals for certainty. They respect the probability, but they also respect the randomness. To put it in everyday terms, think about the weather forecast. If the forecast says there's a 70% chance of rain, you don't assume it will definitely rain. You carry an umbrella just in case. Trading is no different. A chart pattern might suggest a 70% chance of a breakout, but you must still prepare for the 30% chance of failure. The problem is, too many traders leave home without the umbrella. As we close this chapter, I want you to reflect on this. The market isn't designed to be solved like a puzzle. It's a living, breathing ecosystem shaped by millions of participants, each with their own motives. Patterns can help you navigate it, but they won't control it. The sooner you let go of the illusion that charts hold secret codes, the sooner you can start approaching the market with the humility and discipline it demands. The real power isn't in drawing lines on a screen, it's in training your mind to see beyond them.
Chapter 2. The Enemy Within. Emotions overrules the charts. Every trader dreams of that perfect moment. The chart lines up beautifully, the setup screams textbook, and your confidence is sky high. You click buy or sell, and for a split second, you feel like a professional. But then it happens. The candle starts moving against you. Your heart races, your palms sweat, and suddenly all that confidence disappears. What went wrong? The setup was perfect. The analysis was flawless. The enemy, my friend, wasn't the chart. It was you. Trading books, courses, and mentors often teach us to blame the market when things don't go our way. But the truth is, the market isn't out to get us. The real battle is fought inside our own minds. No indicator, no chart, and no pattern can save us if we can't control our emotions. In fact, emotions have destroyed more trading accounts than bad analysis ever could. Let's face it, trading is emotional by nature. You're putting real money on the line, money you worked hard for. Every tick up or down feels like it's pulling your emotions along with it. A winning trade feels like a shot of adrenaline. A losing trade feels like a punch in the stomach. These highs and lows aren't just uncomfortable, they're dangerous because they push us into making irrational decisions that override our analysis. Fear is usually the first monster traders face. Fear shows up in many forms. You fear missing out when you see a stock or crypto shoot up without you. You fear losing money when the trade moves against you. You fear being wrong because being wrong feels like failure. And fear doesn't whisper, it screams. It tells you to close trades too early, to hesitate when you should act, or to chase after a move that's already over. Fear makes you reactive instead of strategic. Then comes greed, the twin brother of fear. Greed convinces you that one winning trade means you're invincible. You catch a breakout, and suddenly you're sure you can double your account in a week. Instead of taking profits, you hold on longer, dreaming of bigger gains. But the market doesn't care about your dreams. The same trade that could have been a winner often turns into a loss simply because greed whispered in your ear to just hold a little longer. And of course, there's the famous FOMO, fear of missing out. FOMO is what makes you chase after a move that's already 80% finished. You see the candles exploding upward, Twitter is buzzing, everyone is talking about it, and you can't stand the thought of being left behind. So you jump in late, and almost immediately, the move dies, leaving you stuck at the top, wondering why you didn't wait for a better opportunity. All these emotions work together to sabotage you. You might have the best technical analysis skills in the world, but if you can't control fear, greed, and FOMO, those skills won't matter. In fact, some of the biggest trading disasters in history weren't caused by bad charts, they were caused by traders who knew the rules but couldn't control themselves. Let me share a story that illustrates this. Years ago, during one of my early trades, I spotted what I believed was a flawless breakout pattern. Everything lined up. Moving averages, volume, momentum. I bought in, and sure enough, the trade started working in my favor. My account was showing green. But then greed whispered, "Don't take profit yet. This could be the big one." I ignored my plan, I ignored my stop-loss target, and I held on. Within hours, the market reversed hard. What was once a winning trade turned into a devastating loss. The setup hadn't failed. My emotions had. This story isn't unique to me. Every trader has their own version of it. Maybe for you, it's closing trades too early out of fear. Maybe it's revenge trading after a loss, trying desperately to win your money back. Maybe it's doubling down when you should be cutting losses. These aren't technical errors. They're emotional ones.
The psychology behind this is fascinating. When we win a trade, our brain releases dopamine, the same chemical that fires when we eat chocolate or win at gambling. It feels good, too good. This reward system wires us to chase that feeling again, even if it means taking reckless trades. On the flip side, when we lose, our brain registers it as pain, similar to physical pain. The human brain hates loss. In fact, studies show that losing $100 feels about twice as painful as the joy of winning $100. This is why traders often cut winners too fast, but let losers drag on. The pain of realizing a loss is so strong that we'd rather hold and hope than face it. Understanding this psychology is critical, because once you realize your brain is wired to sabotage you, you can start working against it. The truth is, charts don't fail. Traders fail when emotions hijack decision-making. Technical analysis was never meant to be perfect. It's just a tool. The problem arises when emotions convince us to misuse that tool. So, how do we fight back? The answer isn't to eliminate emotions. You can't. You're human, not a robot. The answer is to build systems that protect you from yourself. Professional traders don't rely on willpower. They rely on rules. They set stop losses before they enter a trade, and they don't move them. They decide profit targets in advance, so greed doesn't keep them holding longer. They size their positions small enough that a loss doesn't crush them emotionally. Think about a pilot flying a plane. A pilot doesn't rely on emotions to navigate through turbulence. They rely on systems, checklists, and training. Trading is the same. If you're relying on gut feelings, you'll crash sooner or later. If you're relying on systems, you'll survive the turbulence. One of the most powerful ways to manage emotions is journaling. Every trade you take should be recorded, not just the entry and exit, but what you were feeling. Did you enter because you had a signal, or because you were afraid of missing out? Did you exit because your plan said so, or because you got scared? Over time, patterns will emerge, not in the charts, but in your behavior. You'll start to see that it's not the market beating you, it's your own habits. And once you see the pattern, you can change it. Another strategy is to detach from the outcome of any single trade. This is one of the hardest lessons for new traders, but one of the most freeing. No single trade should matter that much. If you're risking too much on one trade, of course your emotions will run wild. But if you keep your risk small, say 1 to 2% of your account per trade, you can lose and still feel calm. Trading becomes less about survival and more about execution. The goal is not to win every trade, the goal is to follow your process consistently. Let me give you a practical exercise. Next time you feel the urge to enter a trade impulsively, stop and take a deep breath. Ask yourself, am I trading the chart or am I trading my emotions? If the answer is emotions, step away. Walk around the room. Wait for the setup that matches your plan, not your feelings. It sounds simple, but it's incredibly powerful. The irony is, most traders spend years perfecting their technical analysis, studying patterns, backtesting strategies, learning new indicators, yet they spend almost no time learning about themselves. But the traders that last in this game aren't the ones with the fanciest setups. They're the ones who mastered their emotions. They understood that discipline is the real edge. Think of it this way. If technical analysis is the car, emotions are the driver. Even the most advanced sports car will crash if the driver loses control. Your job isn't just to build a fast car, it's to become a skilled driver. As you reflect on this chapter, I want you to remember one thing. Your worst enemy in trading is not the market, not other traders, not the algorithms. Your worst enemy is the person staring back at you in the mirror. And until you learn to control that person, no chart in the world will save you. here's the good news. Once you do gain control, once you learn to recognize fear, greed, and FOMO for what they are, you unlock a power that most traders never find. You stop being reactive and start being intentional. You stop sabotaging yourself and start giving your analysis a real chance to work. You stop being just another victim of emotions and you start becoming a professional. And that, more than any pattern or indicator, is what separates the traders who survive from those who disappear.
Chapter 3. The market moves the way it wants. If you've ever sat in front of your screen, watching a perfect setup fall apart in seconds, you've probably thought to yourself, what the hell just happened? The chart looked perfect. One moment everything lines up. The pattern, the indicators, the volume. You enter the trade feeling like you're about to catch the move of the year. Then suddenly, the market flips. Your stop loss gets hit, and the trade you were so confident in is gone. Welcome to the real truth of trading. The market doesn't care about your lines, your indicators, or your carefully drawn patterns. The market moves the way it wants, when it wants, and for reasons you often can't see. This is one of the hardest truths for traders to accept because it forces us to admit how little control we actually have. We want to believe the charts can predict the future. We want to believe if we study enough, backtest enough, or draw enough support and resistance levels, we'll crack the code. But trading isn't about control. It's about surviving in a world where chaos, randomness, and invisible forces dominate. One of the biggest reasons technical analysis fails is that it assumes the market behaves logically, as if every trader is looking at the same charts and reacting the same way. But the reality is, the market is not a classroom where everyone follows the same rules. It's a battlefield filled with different players, retail traders, hedge funds, banks, institutions, and algorithms, all with different goals, different timelines, and far more capital than you. Let's talk about institutional players for a moment. Retail traders like you and I might enter with a few hundred or a few $1,000s. But institutions are moving millions or billions at a time. When they place trades, they don't just buy or sell at the click of a button. They spread orders across multiple exchanges, use algorithms to mask their intentions, and sometimes deliberately push prices into areas where retail traders have stop-loss orders. This is called a liquidity hunt, and it's the reason why your perfect setup often gets wicked out before the real move begins. Think about it like this. If a bank wants to buy 1 million shares of a stock, they can't just hit buy. If they did, the price would explode upward instantly, making their purchase far more expensive. Instead, they manipulate the market to flush out sellers, trigger stop losses, and create liquidity at lower prices before entering their positions. That little dip that took you out of your trade? It wasn't bad luck. It was a liquidity grab designed to fill the orders of big players. This is why so many chart patterns fail. You think you're trading a breakout, but the breakout is engineered by institutions to trap traders. You think you're trading reversal, but the reversal is just a temporary fake out before the real trend continues. Institutions don't care about your technical analysis, they care about finding liquidity, and retail traders are often the ones providing it. And then there are the algorithms. Today's markets are dominated by high-frequency trading programs that execute thousands of trades per second. These machines don't care about head and shoulders patterns or Fibonacci retracements. They're programmed to exploit inefficiencies, arbitrage price differences, and react to order flow faster than any human could ever be. When you place a trade, you're not just trading against another human being, you're trading against machines that are smarter, faster, and less emotional than you'll ever be. This brings us to the uncomfortable truth about backtesting. Many traders swear by it. They test their strategy on years of historical data and convince themselves they've found the Holy Grail. But here's the problem. Backtesting only works on the past. The market you're trading tomorrow will not behave exactly like the market of last year or 5 years ago. Conditions change, algorithms evolve, regulations shift, news events shake everything up. Backtesting gives you the illusion of certainty, but it's like studying old weather patterns to predict a storm. Sometimes it helps, but sometimes the storm doesn't care about the past.
Let's put this into perspective. Imagine you design a strategy that works beautifully on the S&P 500 from 2015 to 2019. You backtest it and see amazing results. You feel confident. But then comes 2020, the year of COVID-19. Suddenly volatility explodes, markets crash, central banks intervene, and all your backtested results go out the window. The system wasn't bad, it just wasn't built for a world where new factors completely rewrote the rules. That's the thing about the market. It's not static, it's dynamic, ever-changing, and influenced by things you can't predict. Interest rate decisions, political events, wars, natural disasters, earnings reports, these events can destroy even the most perfect setup in an instant. A company could show a bullish chart pattern, but if they release poor earnings, that pattern means nothing. A currency pair might be in an uptrend, but one comment from a central banker can reverse it instantly. This randomness is what makes trading so frustrating and so humbling. Studies have shown that as much as 70% of short-term market movements are just noise. That means most of what you see on a chart isn't even meaningful. It's random fluctuations caused by millions of micro-decisions, news headlines, and algorithmic trades. Trying to predict every move is like trying to predict the direction of every wave in the ocean. It's impossible. The best you can do is ride the bigger trend and manage your risk when the waves get choppy. Let me share another story. During the 2021 GameStop saga, thousands of retail traders piled into the stock, convinced that technical analysis confirmed a breakout to the moon. And for a while it worked. The stock soared as short sellers got squeezed. But when the dust settled, most latecomers were left holding the bag. Why? Because the market wasn't moving based on technical setups, it was moving based on a unique, once-in-a-lifetime mix of social media hype, institutional short positions, and sheer momentum. Charts couldn't predict that. Technical analysis didn't fail because it was wrong, it failed because it wasn't built to handle the madness of human behavior and institutional power colliding. This is why the best traders don't treat technical analysis as a crystal ball. They treat it as a tool, one piece of a larger puzzle. They understand that the market moves the way it wants, not the way the charts say it should. And instead of trying to predict every move, they focus on managing risk, adapting to new information, and respecting the randomness. It's humbling to realize, but the sooner you accept it, the better your trading will become. The goal isn't to control the market. It's to survive it, to adapt when it shifts, to cut losses when it turns against you, and to ride opportunities when they align with your strategy. As traders, we crave certainty, but the market offers none. What it does offer is opportunity, if you're willing to accept uncertainty as part of the game. When you let go of the illusion that the market will obey your lines and indicators, you free yourself from frustration. You stop demanding control and you start playing the role of a surfer, riding the waves instead of fighting them. So next time your perfect setup fails, don't blame the chart. Don't blame yourself. Understand that the market will always move the way it wants, and your job isn't to predict every twist and turn. It's to stay disciplined, manage your risk, and be ready for the moment when the chaos lines up in your favor. That's the true edge in trading, not predicting, but surviving.